Good afternoon, everyone. This is Brad Matheny. I thought I'd take a moment to go over some of the Mint movers today. Today is Monday, July 31st, and take a look at what's going on, letting you know what I see in the markets. Let's go over some basics first. So let me come down here, and first off, go over our general game plan. Okay, the Ment rotational modeling system is 100% bullish, meaning that we expect the markets to try to continue to push higher over the longer term. The Ment volatility index, which is a measurement of price volatility and trending, is at 18.53. If you watch the videos, you know that that's very high, very overextended, very bullish, but very high, bullish and toppy. The smart money index is at 43%. It actually moved up, which is a indication that we're getting closer towards a volatility event. It only has to drop down here below 45, values above 65 represent a higher probability of a volatility event. So understand that we're still fairly low, but we're getting closer to a volatility event. U.S. global market indexes are mixed. We're seeing some weakness in the general market. U.S. stock market valuation is at 2.74 and falling, indicating that we're not getting any real organic trending, organic economic growth. It's basically stalling. We're seeing kind of a speculative rally right now. Fear index is rising at 5.77. It has gone up a little bit last week. 6 is where I start warning of moderate fear. So we're getting closer to a rising fear level, but nothing yet. And the sentiment index is at 7.69%, which means we're 7.69% away from a standard deviation middle channel, and we're falling in a downtrend from 4 bars ago. So this is an indication that we are moving into kind of a sideways potential topping pattern. Now, given this indication that we are 100% bullish, nearing toppy activity, kind of, maybe close to a volatility event, getting some mixed reactions with no real organic growth, we have to decide for ourselves what we're going to try to do with regards to allocation. Now, the primary sectors with the Ment rotational modeling system are still all bullish. In fact, last week the retail sector turned bullish as well. We got consumer staples are bullish, financials are bullish, XRT daily turned bullish, real estate still bearish. All the primary sectors are bullish. At this point, there's really should be fairly little fear in trying to take a trade, trying to buy into this upward trend, other than the fact that we're getting some early warning indication that this trend is kind of overextended, may be due for a pullback, and that is why I'm keeping the allocation levels down near 20% for stock investing. The purpose behind this is if you're in a trade and you've gotten into a trade 3, 4, 5, 8 weeks ago and it's doing really well, perfect. Just trail your stops and ride this sucker up. If you are looking to initiate new trades, when you initiate a new trade, that's the highest level of risk because you're taking full position into the market. You have a stop level, but you do not have inherent profits in the trade. Therefore, you have a higher degree of risk. So what I'm telling you is you can still trade with a smaller amount of your capital, so that you do not take any unwarranted risk right now. Allocation levels basically should be trade 20 to 30% of your capital into swing trading. Keep about 30-40% in cash, about 20-25% in metals, and about 15% in bonds. Bonds are not, skyrocketing, but they're holding up, just below 100, and that's pretty solid. I think we're going to see things change over the next year or so with the Fed, particularly going into the election season. So we've only got about 4 or 5 months to go before the real election season starts for the big elections next year. Okay, so let's come back over here and take a look at the list. And what we're going to do is we're going to go through some of the primary triggers. Let me see if I can drag this over. So CHK, this is the daily side. This is the weekly side. Let's go ahead and take a look at the weekly side. We have DEC. This is the new trigger I created last weekend, indicating we have a pretty good trigger set up. So this is my SPY chart. So we will just go DEC. We'll start on this weekly chart here for DEC. Pretty good rally, folks. Let's see how far back it goes. We do not have any real upward resistance areas. This has been a nice solid trend. You can see that we're catching the very, I don't want to call the end of it, but we're catching an extended trend here. As long as this trend continues, it looks good. I try to draw these channels. I want you to visually see these channels set up and understand that we're trying to catch entries off of these types of bases, like right here, off these lower channel bases. That's where we want to try to get into a trade. We've got to pull back here. We don't have a base down in this area yet. Wish we did, but we don't. It is a solid trigger. I would be fairly cautious of extending this further to the upside at $540. You've got to realize that in reality you're talking about a maybe 4%, maybe 5% upside target, and you're looking at probably keep it a 1-to-1 ratio and trail this up. Yeah, you probably have to keep your stop down here about 5.5%. Now this is on a weekly basis. If I come down here on a daily basis and really take a look at it, yeah, we've got this reversal on Friday. Big, this is a Three River Morning Star reversal. Very solid upward reversal. The real support level would be the midpoint of this bar, roughly right around there. So that means that we could come in here and adjust our stop to here, 3.12%, and then we could have an upward target here, maybe in the 3.8, and then possibly an upward target maybe around 3.8 to do the math real quick. Yeah, probably right around 6 3/4. So that gives you a $36 target and roughly a $20 target to the upside with a, let's take a look here, with a $16 risk. That's doable. Again, smaller allocation. If you can't handle the risk, given the way the market is right now, run your allocation levels based on smaller allocation. So hypothetically, if you have a small account, $2,000, $3,000, you might only trade 1 or 2 shares. Okay, it's just the way that it is. Sometimes you got to start small. Okay, we have a trigger here, veil. And what I'm trying to do again, folks, is show you how I look at these so you can learn to make the decisions yourself. Okay, notice the spotty activity here. You see all these little gaps, all these little price gaps all over the place. So this is going to have a bit more volatility in terms of trend channeling. It may be a fun one to trade, very short term, but I wouldn't try to put too much into this. We've got this channel to the upside, so you can see we've broken this channel. Let's see if we don't have anything there. So we're going to come across here, assume this is the channel, and then possibly assume this is our channel. And what we are going to do now, folks, is this is the basing that I was looking for. Okay, this is that basing that I was looking for, kind of like right here. We do have this breakout trend, looks pretty good. We have an upside potential here where we could get 7, maybe 7 and 8% upside move, and we have a downside risk of maybe down just below this low, 3.58. So we've got a 2-to-1 risk reward ratio here. And that's just to get to this first target. So in theory, we could assume that we may be able to get a little further. 14%. Okay, so this has got a pretty good setup, particularly off of this base right here. Very low risk. You can place your stop right below this candle here, right below this base. Could get a little low, you know, a little lower if the market does revert back down. You want to run maybe a very small position in here. It's a $15 stock. You know, you have a chance here at maybe a 7, 8, 9% rally with about a 3.5% risk. This is the type of trade where you could put it on, trail it, stop up, pull 50, 60% off on this level, try to let the rest of it run. This is a decent little breakout trade setup with a very low risk to reward setup. So it looks very good. Let's come over here, CHK. And this is what I want to teach you how to do. Just look at these triggers. I've highlighted the setups for you with these blue markers here. These indicate that they meet the basic criteria for a 33 thrust pattern. And like I said, I like to look at the weekly, see what's actually going on. This is Chesapeake Energy. You know, it was a $7 stock a long time ago. It's kind of channeling, running into some resistance here. I mean, it is moving upward. You can see here it's moving upward, kind of flagging. So does it have that basing level? It does right here, a double base. It has a nice little base right here. Could come back down and run into some resistance here. Let's go back to daily, and you can see here we've got, we've got this double basing back over here, or the single basing, and I would tell you that ideally you're probably better off trying to wait to see if it gets down below that level, kind of the midpoint of this basing level, and running a potential target maybe 4 or 5% up with a stop level maybe 2.5% down. That's a 2-to-1 risk reward ratio, or reward to risk ratio. That seems, you know, fairly logical. It's not a great big uptrend, you know. It doesn't scream to me that this is going to be breaking out to the upside. I mean, it could. I'm not trying to tell you what I do or don't see here. I'm just telling you that this does not look like a massive upward trend. Now, it is top of the list, and it just got flat on the TTScanner trigger here, so it is top of the list. There's a pretty good chance this is going to continue. We are at new highs. You know, I would just be cautious. I would maybe wait a day or two, see what happens to the market, given my feedback, and or maybe start with a small anchor position. It's an $80-some stock, so you know, maybe start with a small position, set it up, see if it pulls back, see if you can get in at this lower level. Then if you do, if it does pull back and you want to jump in at this level, then just move your stop down below this recent base level. Remember, the base level's right here, and then wait for hopefully a pullback and then a rotation back to the upside, and you can load up a little bit more. Okay, next, ARKQ. I remember telling you guys about these about 2 months ago. Yeah, look at that. Way back over here, telling you how it was going to, these innovation stocks were going to really start to take off. Okay, well, this looks beautiful. I mean, this is the type of trigger we want. I'm going to run up to this area here, and I'll explain to you how I came across these lows. This is called rejection, something that was taught to me many, many years ago. Okay, and it was taught to me in a kind of a convoluted manner. It was taught to me in a failure to fail or failure to succeed manner. So failure to fail means that it is succeeding. Failure to succeed means that it is failing. So understand that when you get a breakdown like this in this downward channel, this is essentially saying, look, it's trying to get through this lower channel, and if it were to succeed, it would have gotten further down, correct? Okay, makes sense. But what actually happened? The very next bar, it rolled back up. So this was a failure to succeed. This was a failure in this breakdown of price, and it rallied all the way back up. You can see here, all the way back up 18%. And then it broke out over here. It tried to succeed. It stalled out. Then eventually failed, came back down to the middle channel. So here we have a potential breakdown again that failed with a new rally here. Okay, you know what? This looks like it could be something pretty interesting. Let me extend these out a little bit. And let's see where these lines project to. And understand that we have this gap, we have the Sarami line, we have these little dojis over here. You need to be aware that when you get clusters of dojis, here's a cluster of dojis rolling over, here's a couple of little dojis right here, here's a couple little dojis right here, a couple little dojis right here, a couple little dojis right here. When you get clusters of dojis, these become support and resistance levels, okay? That's what they're telling you. These little clusters here become a support and resistance level, and that's what it's essentially telling you, is that this is a cluster level for price. This is a congestion level for price. So now at this point we have, from where we're at right now, maybe up to this area, 6.53%. Not a horrible move. Maybe could get a little further, so I will try maybe to there, 9.85, and I'm just guessing. You know, this one rallied up for almost 2-3 weeks, so we could rally up into this area. And my downside risk is roughly from this area to here, about 3.5%. This is the trade I think you could be fairly safe with, in the essence that you have a contained risk level. You know, you could put your stop level down in this lower area, 3-4%, somewhere down in here. Let the trade mature, wait and see what happens, trail the stop up. Once you get the stop above break even, which is where you're going to be right around here, assuming we open in this area tomorrow, then you can be a little more liberal with your stop. Remember, you'd want to probably pull 60% off here and let the rest of it run, see what happens, okay? And you would want to use the Fibonacci price theory. So understand that we've got a good series here of taking out highs. So this move here took out previous highs back over here. Whoops. Let's try that again. Took out this high here. Took out this high here. And then we rallied back up over here. Took out this high here. And then we rallied up, stalled. Here's our pivot highs here. You can see them very clearly. We rallied back above that. Took this level out, created a new pivot high, rallied above that. Now our pivot high, we have one here, we have one here. We just took this one out right here. That's a clear break to the upside based on Fibonacci price theory. And seeing as though we've had this big move to the upside, you could apply a Fibonacci level from this current ultimate high to any of these most recent lows. Okay, I would probably pick this middle one here simply because that's the way I like to think of price. Midpoint is, in Japanese candlestick terms, called the belt line theory. Okay, so belt line indicates control of price. So this is actually above the midpoint. I'm going to come down here and I'm going to say that we need to stay above this level right here. This 382 level and 5.0 level, I'll draw a box. We need to stay above this level right here. in order to continue this uptrend. So ultimately, based on Fibonacci price theory, this was, again, if you take a look at the 50% level, and I want you to be clear on this, so look at where the 50% level is. Okay, this low was above the 50% level, indicating that it's too tight, it's too high. We can't rely on this yet. Once we get a little higher, we can rely on it. So we have to go to the next unique low, which is this one, below the 50% level, and that gives us our trailing level, which is between the 382 level and the 5.0 level. I'll do it again on another chart for you. Let's take a look at ALLY. ALLY. Okay, daily chart, kind of building momentum. You see here, we're building momentum. We're running up against some resistance right over here, so we have to keep that in mind. We have a fairly clear channel. You can see it right across these levels. I will play around with the rejection here and here. You see this rejection, and then that gives us a channel up here that we can use to try to determine where we think price may go. So we're fairly clear above this level, meaning we have a potential, a very easy potential up into this level. It's only 3%, 2.5%, 3%. Not really stupendous. And if we take a look at this level here, like I did with the Fibonacci system, we do have a very clear upward trend. We'll grab this. We'll look for the most recent low below this 50% level, which is right here. Prior to that, we'd have to go way back down over here. So if I were to take and move this to this low here, we need to stay above this 38250 level in order for this trend to continue. That means we need to stay above that level for this trend to continue upward, and that gives us a roughly 6 to 7% downside risk. Okay, do I like this? Financials are in an uptrend based on the Ment rotational modeling system sector analysis. It could break out to the upside on some strong earnings. It's a $30 stock. I definitely have some risk down here near this this 2872 level. So I would be very cautious down below that level. I would certainly cut my position size down, and I would maybe attempt to do something more along the lines of a 1-to-1 ratio, or maybe on options, and maybe shoot for like a 4.5% target, pull most of it off at that target, and then let the rest of it try to run. You do not want to get overly aggressive when you're this far off of these basing levels. Remember, you are trying to catch things off of these bases, like right here. That's ideally what you want to try to do. When you get a trigger that's already 80-90% up through this mode, yeah, you can still take it. You know, a little bit more inherent risk in the trade, a little bit more downside potential, but there's no reason why this couldn't continue to pop higher. It is a valid trigger with an 8 and a 3, long, bullish, a brand new trigger over here on the daily system. So yeah, you got a pretty good follow through. But again, I would be a little bit more cautious being this high, having this much amount of risk. You know, maybe start with a smaller position, maybe wait and see what happens, maybe just trade what you feel your risk level is in this setup the way it is right now. Don't become overly aggressive until you at least have the tolerance for it. Okay? All right, let's go last one here. ARKW. Another great setup. Very clean trend. I'm going to come up here. And again, remember the way I draw these, folks. This is, I don't want to call it, you know, Brad mode, but technically it's Brad mode. I'm looking for support. I'm looking for these rejections. And I'm also kind of looking for these rejections here. Up, broke through, up, broke through, up, and this is a kind of a secondary, so in reality, you probably could take another line and draw this kind of like that, giving us an outer, middle, and inner and lower channel, okay? But this gives us a pretty good base. So now, we are near the base again. Very good signal. A couple of bases here, a couple of bases here. We do have an upward channel, which we have to be aware of, unless something big happens, which is 5.5, maybe 7% above this level. We do have a gap. We do have the middle dojis. So ideally, you're going to have to take into consideration these middle doji area as a support level. This means that you have a 6.5% downside risk and a 5 to 7.5% upside target. That's pretty much a 1-to-1 ratio here. Okay, it does look good though. I mean, in theory, this looks very solid for an uptrend. You do have some resistance up here. We could run into some resistance up in this area. You know, the advice that I would give you is that this middle area, this middle doji area, is your key support level. And again, when we take a look at Fibonacci, if you come back to the lows here, I'm using this low as the base, all the way up to here. This is the high. Now I want to look for a low that is below the 50% level, that is a unique or standout low. Okay, and that's this one right here. So what that means is that I can move my Fibonacci up to that level, and then you can tell right away that in order for this trend to continue higher, it's got to stay above that level, that little rectangle. And this is a trick that I learned using Fibonacci. This applies to everything going forward. Now, as it, hypothetically, if it were to continue to extend, okay, if it were to continue upward like this, you would be able to continue to expand all of this. You would basically, you would basically continue to, you know, run your middle ground area here up to these areas, and then find that 50% base area here. Run it up to this area, find your 50% base area here. It'd be the same one right back over here. And then as it rallied up even further, you'd come up and find your 50% area, which would be right here. Okay, then what you would do is you would move your target up to here, and that would show you that you have a range, again, to maintain this trend upward right in this area as your critical support level. Okay, the whole, it works no matter what the trend is and no matter what happens, but you need to wait until you have a substantial range to be able to move this lower channel up. So hypothetically, back down here in this area, you know, could I consider this, and what is the term that I use to consider whether I'm going to move it or not? Okay, it basically comes down to the amount of risk involved in the 50% area down to this lower channel. So there's a 20% risk right there. That's, to me, excessive. I'm not going to run something with a 20% risk. You know, maybe 11, maybe 15. So in reality, if I take a look at this and I were to come back over here, and when we got down to this area, we'll take from the 50% area down here. So that's 14, 15. Okay, so maybe at this area, I would start to move the bottom area here up to the area which is the lowest low, unique low price below the 50% area. And then that tells me when I get to this area, I need to be above this level to maintain this upward trend. You understand? It's actually very, very simple once you put it into practice. I'll try to create another video for you. Okay, guys, let's leave it there. Remember, we've got a lot of good triggers here. Nothing on the Reddit list, which was quite surprising. One in DTE, but we have a couple of very good triggers over here on the value list. Now, value could start to come into play here. Value stocks could become very hot if technology and other sectors start to weaken. So be aware that the value list could become a nice, solid resource for good trade setups moving forward. Okay, guys, remember, come to Ment.com, check out what I do. All of this is available through my Expert Growth subscription. And remember that you can get a 60-day trial for $34.99. I'm teaching you how to use these triggers, how to basically look for these little blue and purple setups. The purple setups are the bearish setups. You do not want to be overly aggressive on a bearish setup until we move into a downward trending market, although we do get them and you could look for them. This is the weekly setup. This is the daily setup. Daily setups typically last somewhere between 3 and 10 days. Weekly setups typically last somewhere between 3 and 10 weeks. This is two systems running. The TTScanner system runs here with these new triggers with the targets, and then you have what's called the 33 thrust system here, which is a new system I'm trying to teach you guys how to use effectively to find great trade opportunities over here. The goal is to provide you access to the resources to allow you to make better decisions and control your own destiny going forward. Okay, guys, that's it for now. Talk to you later.